A good place for us to begin is with yields, particularly Treasury yields, because like all insurance companies, Metlife has had to invest in bonds, principally investment-grade bonds, at brutally low yields for most of the past decade.
That's right. I'm glad you understand our situation.
Now, of course, yields are rising, and maybe that might be appealing longer term in the sense that you can buy bonds at higher yields, and that earns you a better return. But in the meantime, all the bonds you bought are trading or will be trading at much lower prices. Do you care?
Not really, and I'll say why. First of all, if you look at our balance sheet, we have significant unrealized gains in those bonds at this point in time. So as interest rates rise, those unrealized gains will start melting away essentially. But the real issue comes down to, are they credit problems or are they just interest rate related? And this is all interest rate related. The credit quality of our book is very high, and we feel very confident about it.
And you don't trade.
And we don't trade. We call ourselves buy and manage, basically.
How much of your credit book effectively is fixed rate exposure and how much of it is floating?
Well, we mostly it's fixed rate, but we do have floating rate exposure in the book for different reasons. One is we have shorter liabilities. Two, we also have some of our capital markets businesses are floating rate liabilities as well. So we do have floating rate exposure, but most of the book is fixed rate.
Steve, there are people peddling a solution to the low yield problem, and they're called private credit managers. They include some of the largest alternative asset managers. Blackstone, for instance, has ambitions to attract $100 billion in capital from insurance companies managing private credit on their behalf. Does that mean Blackstone is going to be competing with what you do?
I think they do intend to compete, and there are plenty of people that already compete in that business when you look at other large asset managers, particularly those that have focused insurance asset management businesses. So they will compete with us. I would say this, though. When we started MetLife Investment Management, our focus was really on investment-grade private assets. So for now, we still compete in different realms, although we'll see whether they try and move more into the investment grade. When you look at what we do in private assets, commercial mortgages, private placement, corporate debt, private infrastructure debt, it's by and large nearly all investment grade.
That said, they want to take some of the credit product they're originating lower down in the capital structure and package it in a way that it can appeal to insurance companies. Might that possibly make MetLife a client?
Well, I think when we look at those, we're always open to different opportunities. In the past, we have done it mostly through our alternatives portfolios. But what we've generally decided is when it comes to credit products, we can generally do most of what we want to do ourselves.
What about infrastructure? Do you originate your infrastructure investments all in-house, or do you prefer third-party fund vehicle?
We do. Again, what we do in infrastructure is all debt, most of it on a private place basis. But we originated it all ourselves. And again, last year we originated almost $4 billion of new infrastructure debt investments on top of another $8 billion or so of corporate private placement debt.
What does it feel like 2018 is going to be like? More opportunity in infrastructure?
There's going to be more opportunity, and again, we also are looking for the United States to sort of open up the opportunities here a little bit more. When you look at what we do, the majority of what we do has been outside the United States, and a lot of it.
What would you like to invest in here? What would you like to be lending to?
Airports are a great opportunity. If we think about the United States, in the 50 United States, there are 0 private airports. Everything is publicly owned. I think those are great opportunities for us. And so I know that the House has actually reauthorized a bill that would allow for airports to be privatized.
Steve, almost a year ago, we were talking about a deal you did for a company called Logan Circle. It was previously part of Fortress Investment Management. Now, obviously, it's part of MetLife, brought you some $35 billion in assets. People don't look at insurance companies as necessarily as great consolidators. How's that deal going?
It's going very well. In fact, that $35 billion is now $38 billion, so they continue to grow. And it's been very successful for us. And as I said at the time, you may recall, I described this as our opportunity to really jumpstart the public fixed income business. And that's what we're continuing to do. And now we're also pursuing other insurers on a more comprehensive basis.
Are you going to be more of a consolidator?
Consolidator, I'm not sure if I'd use that term. I would say that given where we
Will you
are
buy
in
other
this
asset
business,
managers?
we would still acquire. Yeah, I think our opportunity is still to acquire other asset managers. So you can call it consolidation. I look at it as still building out our capabilities. And in fact, when we look at what we're doing on the acquisition side, what I really like are the opportunities that are sort of contiguous to what we're doing today.
You have, what, $175 billion in outside capital?
About 160, 170 billion.
Where would you like that to be?
Well, ultimately, if you take a longer term, sort of 3 to 5 year perspective, we want that to be $500 billion. I think that's where it needs to be in the context of Metlife, in the context of being a very competitive asset management firm.
You'd need to do some deals to get there.
We do. We're going to continue to grow it organically, and again, over time, we think that there will be acquisition opportunities that will allow us to keep growing it.